Welcome back to The Explainer. Today we're taking an in-depth structural look at a company that quite literally keeps America moving. We're talking about CSX Corporation. We're going to break down their incredibly impressive August 2026 performance, analyze the metrics that are really driving this momentum, and of course, objectively map out the road ahead. Now, just a quick reminder before we get rolling, this explainer is strictly for informational and educational purposes. We're looking at the data today, but nothing here is financial advice. All investments carry risk, so you should always consult with a qualified professional before making any moves. All right, let's get into it.
Okay, let's dive into this. Here is our itinerary for today. First, we'll meet CSX Corporation. Then we're unpacking Q2 financials, followed by fueling the turnaround, Wall Street's verdict, risks on the rails, and finally, the road ahead. We're going to cover both the massive operational wins and the looming market risks.
Section 1. Meet CSX Corporation, an American freight giant. To really grasp the numbers, we first have to understand the physical reality of this business.
And the driving force behind all the recent headlines is a staggering 40% year-to-date gain for the stock. To put that into perspective, they are absolutely crushing the S&P 500, which only saw a 6.9% rise over that exact same period. As of late August 2026, the stock was trading around $51.76. That brings their total market cap to a massive $95.88 billion. Think about that. That makes this railroad larger than many major tech companies. And that kind of valuation growth, it doesn't just happen by accident.
That stock surge is backed by an immense physical footprint. CSX is a Class 1 railroad, meaning it's one of the highest revenue-generating freight systems in North America. Their operations span 26 states entirely east of the Mississippi River, plus Washington, D.C., and they even push up into parts of Canada. We're talking about a highly dense, heavily populated region. Across the sprawling network, they're moving everything: merchandise, coal, automotive products, in thousands of intermodal containers. Those are the massive shipping containers that transfer seamlessly from ships right to trains and onto trucks every single day.
That brings us to Section 2, Unpacking Q2 Financials, Record-Breaking Quarters. Let's look at the hard data from July 22, 2026, which really set the stage for this crazy stock ascent.
Now, what's really interesting about this slide is the sheer velocity of this turnaround. Let's look at the free cash flow swing. This is the actual cash left over after operating and maintaining the business. In the second quarter of 2025, CSX was sitting at negative $115 million. Well, exactly 1 year later in Q2 of 2026, that flipped to a positive $687 million. That is an $802 million swing in just 12 months. It's a massive testament to their newfound operational efficiency. And those free cash flow numbers are fully supported by top-line beats across the board. Revenue hit a record $3.94 billion. That's a 10.1% increase year over year, easily beating consensus estimates. Earnings per share jumped an impressive 23% to $0.54, which again surpassed expectations, and their operating margin expanded to 38.3%. In plain English, CSX isn't just making more money, they're operating so efficiently that they're keeping a much larger piece of every single dollar that comes through the door.
When we break that revenue down by segment, the standout is super clear. Intermodal revenues surged by 26%, bringing in $620 million. But it wasn't just intermodal doing the heavy lifting. Coal improved by 9%, and merchandise grew by 8.4%. Across the entire network, total volumes increased by 6%, largely led by a 9% volume growth in that booming intermodal sector. Because intermodal involves moving consumer goods, a surge like this is often a really strong indicator of broader economic health.
Section 3. Fueling the turnaround, infrastructure and operations. We've seen the spreadsheets, but how did they physically make this happen?
The context here is absolutely crucial. At the 2026 annual shareholder meeting, CEO Steve Angel openly acknowledged that 2025 was a notoriously difficult year for the company. They were plagued by severe weather and soft freight conditions. But they didn't just sit back and weather the storm. They used that downtime to aggressively push through major infrastructure projects. As Angel put it when talking about the Howard Street Tunnel expansion in Baltimore, they are literally clearing a century-old bottleneck.
And that Howard Street Tunnel project is a huge deal. At $450 million, it finally enables double-stack intermodal service through Baltimore on the vital I-95 corridor. But that's just one piece of the giant puzzle. They also rebuilt 60 miles of the Blue Ridge subdivision that was completely destroyed by Hurricane Helene flooding. They managed to restore that in under a year,
which required a staggering 570,000 man-hours of labor. It turns out, financial turnarounds are built on the backs of physical, grueling labor. Plus, they finished the 75th Street Create flyover in Chicago to add critical network capacity. The financial wins we're seeing are a direct result of these massive physical undertakings. And this brilliantly illustrates how CSX isn't just relying on laying steel and pouring concrete. They are actively modernizing. They're leveraging artificial intelligence and predictive analytics to vastly improve network flow and asset utilization. Think of it like a highly advanced GPS for thousands of trains, predicting delays and optimizing routes in real time before bottlenecks even happen. It's working too. This efficiency let them add 85 new or expanded rail-served facilities in 2025 alone, and they currently have about 600 customer-related development projects in the works.
Moving right along to Section 4, Wall Street's verdict, consensus and targets. Let's see how analysts are digesting this blend of physical expansion and financial surging.
If we look at the broad consensus from MarketBeat, which tracks 26 brokerages, the sentiment is decidedly positive. We're seeing an average rating of moderate buy. That breaks down to a strong 18 buys, 7 holds, and just 1 sell rating. The consensus average price target sits around $51.31. But as you're going to see in a second, individual firm targets vary quite a bit.
Taking a closer look at specific actions from August 2026, Bank of America and Argus Research are both at a buy with $56 price targets. Wells Fargo sits at a buy with a $54 target, while Bernstein maintains a hold at $48. But it's really worth noting the extreme ends of the spectrum here. Targets range anywhere from a highly bearish $32 all the way up to a bullish $60. That massive range tells us something important. It tells us Wall Street is actually deeply divided on whether this momentum is a permanent new normal or just a temporary peak.
Which brings us to our reality check in Section 5, Risks on the Rails. To truly understand this explainer, we have to look objectively at the headwinds CSX is currently facing.
So, the crucial point is valuation. Right now, CSX is trading at a price-to-earnings ratio of approximately 28.2x. Simply put, investors are willing to pay $28 for every $1 of earnings the company generates. This means the stock is trading at a very significant premium compared to its own historical averages and to many of its industry peers. When a stock is priced for perfection like this, any minor operational slip-up can lead to a really harsh market correction.
And there are for sure several potential catalysts for a slip-up. Higher diesel fuel costs remain a constant headwind. There's also the matter of insider selling. Over a 90-day period, insiders sold almost 190,000 shares worth $9.1 million, which, always raises some eyebrows. Operationally, management admits to seasonal service fluidity issues due to crew availability, and they're seeing some market moderation in the auto and plastic sectors. But perhaps the biggest looming shadow is industry consolidation. Union Pacific has proposed a massive $85 billion acquisition of Norfolk Southern. This would fundamentally reshape the competitive landscape. It's such a big deal that CSX actually launched a dedicated website just to voice their concerns about it. When a company spins up a PR campaign against a competitor's merger, you know the threat is highly material.
Finally, Section 6, the road ahead, 2026 guidance. Let's see what management expects for the rest of the year.
Let's move to and see how this builds into their newly updated guidance. Q2 was so strong that they basically had to revise their expectations upwards across the entire board. Revenue growth was pushed from mid-single digits to mid to high single digits. Operating margin expansion expectations jumped from around 200 to 300 basis points to greater than 350 basis points. And look at that free cash flow growth expectation, adjusted from greater than 60% to now greater than 80%, all while keeping capital spending capped under $2.4 billion.
With that incredible cash flow generation, the board is heavily signaling their confidence by returning capital to shareholders. Back in May of 2026, they authorized a massive $5 billion share repurchase program. By buying back their own stock, they reduce the supply of shares in the market, which fundamentally increases the value of the shares you already hold. And on August 31st, shareholders received a quarterly dividend of $0.14 per share, representing a 1.1% annualized yield.
Which leaves us with this final provocative question to consider. Can CSX's massive infrastructure improvements and AI investments truly sustain a 28.2x premium valuation, especially as looming industry consolidation threatens to completely rewrite the rules of the rail? That is the multi-billion-dollar question facing investors right now.
Thank you so much for joining me to unpack the data today. Remember to always do your own research, stay focused, and I will see you in the next explainer.